You have a compliant NI 43101. Your management team has built mines before. The geology is world-class, yet you've been shopping your deck for 6 months and you haven't seen a single term sheet. You think it's the market. You think lenders don't get the resource. You think capital is tight. The reality is this: the project is likely dying because of one specific structural mistake in the presentation. In this breakdown, we'll show you exactly why deals like this get killed in credit committee and how to fix the structure so they actually get funded. Most junior mining teams make the same mistake. They spend 80% of their pitch talking about the upside, the grade, the strip ratio, the expansion potential, the copper price forecast, the lithium demand curve, the gold cycle. They're selling geology, but private capital, especially debt funds, are not buying geology. They are underwriting risk. They are asking one question: how do we get our money back if this goes wrong? Here's the number one mistake that kills the deal: asking debt to take equity risk. In other words, asking a lender who earns a capped return, maybe 10%, 12%, 14%, to take on uncapped risk like construction delays, cost overruns, metallurgical surprises, commodity price crashes, and permitting issues. If a lender wanted equity risk, they would buy the stock. They don't want upside. They want certainty. When the structure doesn't provide that certainty, the deal dies quietly in committee. Let's look at the 3 biggest deal killers that show up as symptoms of this mistake. Deal killer number 1, the Bankable Feasibility Study myth. Just because it's labeled a BFS does not mean a bank considers it bankable. We routinely see CapEx modeled tightly, maybe with a 10% or 15% contingency. From the sponsor's perspective, that feels conservative. From a lender's perspective, it's thin. They're not asking, can this mine work? They're asking, if this goes 15% over budget, who pays? If the answer isn't clearly and contractually sponsor equity, the deal is dead. If there isn't a 20% to 30% buffer, a funded overrun facility, and visible first loss equity, then debt is being pushed into equity territory, and it won't go there. Deal killer number 2, weak commercials. Mining isn't just digging rock, it's selling product. Yet many decks still rely on "we'll sell at spot price" assumptions or non-binding MOUs presented as offtake. From a lender's perspective, that's the same as no contract at all. No contract means no revenue certainty. No revenue certainty means no predictable cash flow. No predictable cash flow means no loan repayment visibility. Credit committees are not betting on commodity forecasts. They are underwriting contracted or defensively hedged cash flow. If the revenue model depends entirely on future spot prices without binding offtake or price floors, debt is again being asked to behave like equity, and it won't. Deal killer number 3, the capital stack gap. This is often the silent killer. The sponsor asks for $50 million of debt on a project with only $5 million of true at-risk equity invested. Exploration spend and studies are important, but lenders focus on how much real cash sits beneath them in the capital stack. If leverage is too aggressive, here's what credit sees. If this goes wrong, the sponsor can walk away, and the lender is left with a partially built asset and limited recovery. Debt wants to sit above a meaningful equity cushion. Debt wants to see that the sponsor's pain comes before theirs. If that cushion isn't thick enough, the deal won't move. So what's the solution? The narrative has to shift. Stop pitching a great mine. Start pitching a robust credit box. That means reframing the entire ask. First, front-load equity. Before approaching senior debt, demonstrate that enough equity has been raised to cover first loss and realistic cost overruns. Show that even if CapEx increases by 20%, the lender's position remains protected. When credit sees real skin in the game and real cash at risk, the tone of the conversation changes immediately. Second, lock in pricing. Before asking for a large debt check, secure binding offtake agreements or implement hedging strategies that establish a revenue floor. Upside can remain, but downside must be managed. Show what happens if commodity prices drop 20% and demonstrate that debt service is still covered. When the model clearly supports a 1.3x or stronger debt service coverage ratio under stress, the discussion shifts into language credit committees understand. Third, tell the waterfall story. Explicitly map out the repayment waterfall. Show where senior debt sits, how operating cash flow is applied, how reserve accounts are structured, how interest is covered during construction, and exactly how the lender gets paid even if production underperforms by 20%. Don't assume they'll infer it, show it clearly. When that clarity is present, the conversation shifts from, "Is this a good mine?" to, "Is this a protected position?" And that's when term sheets start to appear. The bottom line is simple. Capital providers are not explorers, they are risk managers. They are not compensated for believing in the resource. They are compensated for structuring around risk. If you want their money, stop selling them a dream and start selling them safety. If you're sitting on a project that's stalled and can't determine why no term sheet has emerged, reach out or leave a comment. We break down real capital structures here every week. Subscribe so you don't miss the next analysis on equipment leasing for mines, which is often the most accessible layer of capital when structured correctly.